All right, we are back. My name is Andrew Kuhn. His name is Detla Forschlad. Kudos to us for pumping out our second rundown within, a month of each other. We're working hard over here to bring the rundown back very consistently. Detla is back in his dorm room. How's it going, man? How was the move back to the dorm?
It was exhausting. So my dorm is at the top of a huge hill, and I don't have a car, so I had to walk up and down that hill for 4 hours, just moving all my stuff. So it was exhausting, but I like it here, so
Yeah.
I'm better now.
Wow, that's funny. Well, good. Good. And we're glad that
Yeah.
it is all going well. So let's jump right into it because we have a lot of stuff to go over. So last Friday after the close, there was news that came out that Berkshire Hathaway had bought some gold. Barrick, as I am saying this right now, is up 12% right now. Obviously, that really made headlines over the weekend. People on FinTwit, especially QTR and other gold bugs that we referenced in the past, episode, are freaking out about it. But what's that say? I mean, Buffett has long been against investing in gold. So now, do you think it was him? Do you think it was Ted or Todd? What are your thoughts on him investing in gold?
Yeah, it's a good point. My first reaction was, oh my God, this is game changing. Buffett is going into gold. But then, people started saying that it could have been Ted, it could have been Todd, and it's a small part of the portfolio, so it probably doesn't even matter. But it's very interesting nonetheless. As you said, Buffett has been fairly critical of gold, and Charlie Munger has said that civilized people don't buy gold, or has implied that. But I guess it's kind of important to note that Buffett didn't actually buy the commodity. He bought, a gold miner, and it's also the cash cow of all the gold miners. I mean, it consistently generates a lot of free cash flow, has good returns. It seems. I haven't looked, a lot at it, but it seemed like a fine business. So, it could have. I think Buffett or Ted or Todd just thinks that this is undervalued and there's some value to unlock here in a booming gold market. But that this doesn't really have to be a specific bet on the gold price.
Yeah, it's such a small position too. I mean, if it goes to zero, it will be less than what the portfolio is making today in Apple if the whole investment goes to zero. So it's such a small part, but of course everybody, jumps all over it. And
it's really interesting nonetheless. I went crazy on FinTwit too. I was at a dinner with some friends and I got this push notification from a friend of mine and I was like, oh my God, Buffett bought gold. And nobody cared.
We're crazy, aren't we? We're crazy.
Yeah. But you know what I think is interesting? From the same 13F, we found out that he sold all of his Goldman stock.
Yeah.
He sold his stakes in JP Morgan. He kept Bank of America and he sold some Wells Fargo stock. So do you think there's some trade here, like long gold, short the banks kind of?
Yeah, I don't know. I mean, we think that we talked about Bank of America in an episode that everyone said was one of the best bank episodes we've had. It's so funny. Sometimes we'll upload an episode and I'm like, this is probably not a good episode. And people will be like, this is the best episode you've ever done. And then there's other times where I'm like, this is going to go viral. This was just, we just freaking spilled some knowledge on everybody. And then no one really says anything about it. But the most recent video we did where we went over Bank of America and Geoff, walked through the valuation of it and explained it and everything. Everyone said it was, one of the greatest bank videos that we've done. But Geoff thinks Bank of America is probably one of the more cheaper ones of the larger banks. And he thinks banks in general are very cheap, where if you bought just a basket of banks, he thinks they'll outperform the market probably over the next 10 years. But Bank of America specifically, he really, really likes. So I was actually not surprised to see him buy more Bank of America. But no, to your point, I mean, it is kind of weird, right, to think what's going on there. But if I had to guess, I would say it's probably some of the Ted or Todd that made the the investment. But nonetheless, it's pretty crazy and just shows, I guess, how unprecedented the times we are in are.
Yeah, I don't actually think that Buffett is betting against the banks and then betting that would go on the gold standard or something. I don't think that, but it was an interesting thing to happen on the same 13F.
Yeah, totally. Next thing, speaking of assets, lumber futures, people were talking about that. They're just been going bananas at all-time high.
I think they're up 200% in either year to date or over the past month or something like that. Something crazy.
Yeah. What are your thoughts on that? People betting on inflation, or what do you think?
No, I read an article about it, and it's basically the factories that treat the wood were shut down for 2 or 3 months during the pandemic, and that supply chain squeeze finally caught up, a couple of months later, and now there's not enough wood on the market. And so it's not really a demand. People were speculating at first that it was like a demand thing, that people were building a ton of houses and everything, but it's just that people are building houses and they can't find the supply or the material for it.
Yeah.
So I don't have an opinion on what's going to happen.
I mean, housing's been pretty resilient so far through everything.
Yeah.
Now housing is more of a lagging thing, but I've definitely been surprised how well housing's just really shrugged off everything. But no, I did notice that, because we've talked about Cool on Focus Compounding, KEWL, and we don't own it, and we haven't owned it probably for, I don't know, over a year now. I think the stock was at $60, but I don't even think the stock has moved, and the futures have just gone crazy, So I thought that was kind of interesting.
Yeah, I kind of looked at the stock price, and it started the year at like 65 or something, and it went down to like 50 during the March crash, and now it's back to 65 and has moved in over a month. But I don't know. They don't really make a lot of money like year in or year out. It's more like an asset play.
Yeah.
So I guess it probably doesn't. I mean, it obviously impacts the value of their assets, but they're not going to sell it, right? So
yeah,
maybe it shouldn't move. But I don't know.
And then a topic that I wanted to spend a lot of time on is something that, I've been spending a lot of my time thinking about. This weekend, I was actually rereading 100 Baggers. It's a book that I recommend. If you have not read it, you should definitely read it. He drew inspiration from 100 to 1 in the stock market. I don't know who wrote that book. I'm trying to look at my bookshelf right now, but it's a great book. And I tweeted some stuff out this weekend about different ways to, find these 100 baggers. And what's pretty cool about this book is he lists a table of like 300 plus companies that all have been 100 baggers. Now, the only problem with that is a lot of the data goes back to 1962. So it's tough to find like what it looked like at the time. But I tweeted out about Monster Beverage, because that stock was a 100 bagger within, I think, 9.5 years. And it was interesting because I think a good way you could find these companies is they all have pretty good gross profits and gross margins early on. And then it's really just hitting that scale point and really letting that operating leverage take off, where you just get these massive returns where revenue could only be growing, 20 to 30%, but you have like EBIT and net income just exploding and EBITDA exploding higher. And then really how like the market rewards that type of growth. So it's been really fascinating. But I was watching, he gave a presentation for Microcap Club. You can find it on YouTube, Christopher Mayer. And it was just a really good presentation on, sort of the characteristics that a lot of these 100 baggers have. And, if you shoot for a 100 bagger and maybe it ends up being an 8 bagger, a 10 bagger, a 15 bagger, I mean, who's going to complain about that? But, I just thought it was interesting, different types of qualities that some of these companies have. And at the end of the book, on a page 173, he lists 10 core principles. So I figured I could read it off. I have underlined some stuff from the passage, and then we could just sort of chat about it and see where we end up. Does that sound good, Fetla?
Yeah, sounds great.
Sounds great. So the first one is obvious. It's not supposed to be difficult, or more difficult than it already is. But he says you have to look for them. And what I thought was interesting was, he talks about not wasting your brain power on companies that might be able to rise, 30% or 50%. And to your point a couple minutes ago about talking about like asset plays, I feel like a lot of times that's what asset plays are, right? It's like, oh, it's trading, at X and it's probably worth, 50 to 60 or 70% higher. And you hope within, a certain time frame that value gets realized. But he says, you have to look for them and don't waste a lot of your time looking for companies that can only pay 30 to 50%. He says you only have so much time and so many resources to devote to stock research. Focus your efforts on the big game. the elephants, the 100 baggers.
Mm.
So I thought that was interesting. Do you have any thoughts on that?
One thing that I don't really ask myself that a lot, but one thing I think could be useful to ask yourself before you buy a stock or when you look at a stock is, does this have the potential to be a 10 bagger over like the next 100 years or 50 years or 10 years? Because, a lot of stocks don't really have that potential in them. And I mean, a lot of the stuff, like, I don't think Kivana has that in them, the lumber company we just talked about, or most asset plays.
No, you're totally right.
Yeah.
Mm-hmm.
So I guess, and I guess that's what his point is, because most people don't look for it. And
so you're pretty much saying too that the industry has to be, the business has to be set up to take advantage of an industry that can be much bigger. Because we've talked about before how Geoff feels like, I don't remember the exact number, maybe 50% of your return comes from the actual industry that you're in, and how a lot of people should focus on that. And to your point about like KEWL, that company, it's not going to be 100 times bigger, right? That's not really a scalable business. I guess you could buy other, more lumber and stuff like that, but I understand what you're saying. It's not like a Keyword Studio, which I know you're familiar with, or a company like Monster Beverage, where you could see how it could become more of a staple and stuff like that. Okay, principle number 2, growth, and more growth. And he said, so you want value-added growth, but you want good growth. If a company doubles its sales, but also doubles the shares outstanding, that's no good. You want to focus on growth in sales and earnings per share, right? Being a value investor, obviously, just intrinsic value or return on invested capital and everything like that. I mean, a lot of times companies, it's pretty easy to ramp up sales if you have a decent product, right? Doesn't mean you're going to be profitable though. Or you could fully dilute shareholders, as the years go on. I've seen situations where the company was going to dilute shareholders by like 20 to 30, 40% over time if an activist didn't step in. I mean, there's just weird situations,
Yeah, I think there were 4 different companies this summer alone on the Oslo Stock Exchange that probably diluted their shareholders by 50%, like overnight.
Did it was it to raise just new capital, or was it like stock grants and stuff like that?
No, it was to raise new capital. It was to save the companies basically. But yeah.
Still, it's a crappy situation to be in,
Yeah, especially when the existing shareholders can't take part of that that capital raise. So they get like these billionaires and millionaires and the owners of the company to be a part of the capital raise. So they get the cheap money. They dilute the existing shareholders, and who's left holding the bag? That's retail. But to your point, it's very easy. I think it's underestimated how easy it is to actually grow sales versus profits.
Yeah, I mean, you could ramp up marketing, you could ramp up, all things like that.
Lower prices,
yeah. Principle number 3 was lower multiple is preferred. We've talked a lot about this on the podcast, how powerful a multiple expansion can be, especially in a growing company. So he talks about some situations where if you paid even like 3 to 4 times earnings, and how much he goes into the math behind how much that could add to a return if you sell it later on, or if it gets a market multiple later on. I think that's obviously self-explanatory. But it's something that I constantly think about, and Geoff and I, we've been talking a lot more about that recently. I'm kind of the whole, I'll buy a company at 4 to 5 times earnings, and the whole market, it's trading there because the whole market thinks the company sucks, but I'm going to buy it at 4 to 5 times earnings because I think, well, it's actually not that bad of a business. I don't know, how good of a strategy that is. I really like the higher quality businesses. I'm a very optimistic person too. And I don't like to open up the earnings report or whatever and be like, oh, well, they didn't do that bad. I'm like, no, I want to see them crushing it,
Yeah.
and see, the market reward that.
That's a good point.
Yeah. But it's like, where's the fine line? Because even if you study a lot of Buffett's past investments, like his earlier investments, I mean, it's not like he was paying 30 times earnings for a lot of companies, but he may have been paying like a market multiple in his earlier days. If you read the book Capital Allocation, he talks in that. And we actually talked to the author who's going to come on the podcast. And he said that was something that was most surprising to him, was it's not like, now early on in his career, he may have spent a lot of time with, you know, the cigar butts and stuff. But as time went on, he was paying, you know, what some people would call higher multiples for companies and stuff like that. So it's like, where's that fine line, Bella, of not paying too much, not paying too little, not getting in, or not getting like involved with a crappy business. You know what I'm saying?
Exactly. But to your point, Buffett over the past like 20 years or so, he's actually paid like a price earnings multiple of like between 30 and 40 for some companies, for some stocks. You know, I just have a list over here. I just had to Google it because I was shocked when I saw it that he actually bought these companies trading at 35 to 40 times earnings. So he bought Sanofi for 32 times earnings, Iron Mountain for 33 times earnings, Babco Holdings 37 times earnings, Wells Fargo 30 times earnings, probably not normalized. Anyways, that was just a sidetrack. I think that, you know, you're making some great points. It's impossible to know what that fine line is, right? Like, is it 15 times earnings? Is it 30 times earnings? But I do want to read a paragraph from a Costco write-up from 2005. So back then it was trading at, what was it trading at? $46 per share. I'm not sure if it has split since then, but it's at like $350 per share today. And back then the S&P 500 was trading at a PE of 23 times earnings, while Costco was trading at 23.9 times earnings. So here we go. Here's the paragraph. Value investors have long been intrigued by Costco Wholesale. It has a fabulous long-term record of steady growth. It's old school in its management and compensation practices. Berkshire Hathaway's Charlie Munger is on the board, plus any bargain hunter loves to shop there. Not so many value investors own the stock, however, in part because it has extremely low margins, less than 2%, and the stock rarely looks cheap, trading at 24 times earnings per share. So the argument back then was that it was too expensive. And since then, it's been a 10-bagger over like 15 years. So I don't really have a point. I thought
so it's just like it's the high quality. But no, you do. I mean, it's like being investing in high quality businesses and stuff. Because I talked about that because I tweeted that law. I said that because Geoff wrote. Whenever I talk about Geoff writing an old post, I'm like, oh, it's the best post he's ever written, right?
Yeah.
I said about every post he's ever written. But he wrote a post from 2017 where he was talking about learning to move up the income statement and how if Munger calls EBITDA, you know, earnings, bullshit earnings, you know, then you should really learn to move up to gross profits. And, you know, that's like a really good place to start. And I tweeted how, and this came from his article, you know, you learn a lot about the inherent business economics the further up the income statement you go. And then you learn a lot about the people running the business the further down the income statement you go. But I think Costco's business model in general is different where, you know, they're not going to have those high margins, you know, so that's like their whole model in general. So maybe it comes down to like just understanding the business and stuff like that. I mean, you're not going to analyze a steel company where I think the average net margins on a steel company or what would be considered good is if you have like 7% net margins. I don't know if that's what it is now, but 5, 6, 7, I don't know. You know, like you would analyze a, you know, a company that like I don't know, a consumer good business or something like that. So, but it's just something that I thought was interesting. And, you know, really learn about the business by going up the income statement and then, you know, kind of judging it from there.
Yeah, I think that's a great point. Like, understand the business model, because in Costco's case, yes, they had low margins, but that was on purpose. Like the management knew they had low margins and they used that to their advantage. So they sell super cheap products, right? And hence the margins are very low. You know, new customers like the price. So they join up, they buy that membership card, which is like $50 per month or year, per year, right? Costco expands. They now have bigger economies of scale. They can buy cheaper inventory. They can sell these for cheaper prices, and Costco can buy and sell product for cheaper prices. And then the ball starts rolling and more customers join up. And once that ball is rolling, it's like you can't stop it. And that's what this guy who wrote Costco up in 2006 saw, which, you know, a lot of people didn't. It shouldn't have traded at 24 times earnings back then, even though that seemed expensive to a lot of value investors.
Yeah. So it's just something that you're always kind of, I guess bouncing back and forth between, and it's just, again, high quality companies are just way better. I'm just getting more and more convinced by that as the years go on. So then he adds a little part before principle 4. He says, if you get 2 and 3 together, this is what he calls the twin engines of 100 baggers. So basically when you get growth in sales, good profitable growth, and then you get a multiple expansion as well, that's when you can have just incredible returns. He said earlier in the book, we went through the extreme example of MTY Foods. There we had a stock start at 3.5 times earnings. Earnings rose 12.4 times in 10 years, but the stock was a 100 bagger because the price to earnings ratio went from 3.5 to 27 times. He's like, you should know that's rare, but it makes the point rather well, where if you find these situations of being where you can get massive, multiple expansion and growth. And how much of it actually becomes a self-fulfilling prophecy, though, because if the company starts to deliver good, profitable growth, the market is going to reward that usually over time with a higher multiple on those earnings,
Over what time frame did that happen, from 3.5 times to 26 times?
MTY Foods. I don't know. Let's see. I could find it. Hold on.
All right.
Let's see if I can pull up actually, hold on. So they have, okay, maybe I'll have to find it later or something. But yeah, I don't know. I wonder if this one, because he did list a table of ones that reached it in 10 years. I don't know if that fell in that group or not.
Have you seen those charts where you see where you distribute what causes stocks to go up, and there's like growth, and then there's earnings multiple, and then there's the dividend yield, and you can see that over time the multiple expansion or contraction doesn't really matter over time, but the growth really plays a huge role over, say, a 15-year period. But obviously, if the multiple expands from 3.5 times to 27 times over even a 10-year period, that's gonna get you a good return.
This one was over 10 years. It went from 2003 revenue of 11.5 million to 2013 revenue of 101 million. And yeah, EPS went from, or I'm sorry, the shares went from 34 cents to $34.34 over 10 years. Wow. Freaking crazy, isn't it?
It's insane. Insane. Yeah, Jake.
All right. All right. Let's see. Let's go to, number 4, economic moats are a necessity. So obviously I think that's pretty, self-explanatory. Fight off competition. If you ever have a company that does exceptionally well, there's going to be competition that is going to come in and go after your return on invested capital, your margin. It's like what Bezos says, your margin is my opportunity. You ever heard that?
Not before now.
Well, there you go. Learning it right on the rundown. There you go. I could be lying and you just believe in me. No, he did say that.
Yeah.
Right. Number 5, smaller companies preferred. I think that, again, it's pretty self-explanatory, but there's companies that have, you could have bought Apple at a $1 billion valuation or $2 billion or even $10 billion. That one too. Yeah, you could have bought Tesla 6 months ago. I think last time Geoff and I talked about it, it had a $40 billion market cap.
Yeah.
And what's it now? Like almost $1 trillion or something? Just insane.
Yeah, it's it was, people were calling it like a crowded short when it was like $30 billion valuation, because all the hedge funds, all the big hedge funds were shorted because they thought like, this is obviously now worth $30 billion. And I guess I agree more with them than people are bullish on them, but I wouldn't short it. But it's just insane to think about it. It's not that long ago where people were talking about how Tesla was so expensive, one of the most expensive stocks on the market at a $30 billion market valuation.
Yeah, it's insane. I mean, again, getting back to shorting, it's just like return on brain damage. It's just, to me, it's just not worth it. It's not in my personality. I wouldn't want to wake up every day and hope for something to implode.
Right.
Just not my style, but yeah, I mean, again, getting back to Munger's quote, right? Don't underestimate the man that overestimates himself. He was referring to Tesla, and it's sort of like the reflex, George Soros reflexity or whatever. You're kind of seeing that play out in the markets right now, and Tesla's there, and the stock keeps going up,
Yeah.
Imagine being short that company. Imagine being short that company.
Yeah.
How much you're just pulling your hair out every day and constantly.
You know, Mark,
and the thing is, like, a lot of like shorts I see on Twitter, they're so negative about everything that comes out about Tesla. Even if they release something cool, they just like are so negative about it.
Yeah,
because they're talking their book and stuff like that. I'm just like, I just would never want to live my life like that, you know?
Right. Yeah. But they made their whole life to be about Tesla, and they're short, and they're too deep into the hole to turn around. So they just have to die with being a short Tesla.
Yeah.
But I'm not going to say his name, but there's this hedge fund manager who mostly bought deep value microcap stocks from like 2011 till 2016. And he had like an insane run. I think he had a CAGR of 16% or something like that. Like, he was doing really well, beating the S&P 500 handsomely. And then in 2017, he started shorting Tesla. And now it's like, I think he's down like 20% since 2017. So if he had just stayed in his lane, which was something he was really good at, buying deep value microcap stocks, he would have saved his fund first and foremost. Anyways,
I just feel like it's just a hard way to make money, you know?
Yeah.
And I get it. I mean, a lot of people, I get why they, maybe do it or whatever. And some companies are frauds and blah, blah, blah. But it's just a tough way to make money. I feel like it's easier to make money on the upside, you know?
Yeah. As Bill Ackman said, it's a poor return on brain capital employed.
Yeah. Brain damage, ROBD, return on brain damage or something like that, you know? Yeah. I like that. And like getting with the Herbalife situation, I mean, they literally came out and said Herbalife has to start acting legitimately. I mean, you could argue that he was right about the situation, but he was wrong on the outcome, that they're going to come and basically shut down this company that's been around for a very long time, employs a lot of people.
And they made a lot of money, right?
Huh?
And they made a lot of money.
Oh yeah, it was profitable. It was profitable business. Yeah. But I mean, that they literally came out, the regulatory authority, like I remember watching it on CNBC live. I was like cooking something and they're like, Herbalife, blah, blah. They literally said Herbalife needs to start acting legitimately. They were making them change different things about their business and stuff. So, I mean, you could argue that he was right on the situation. He was just wrong on the outcome. And unfortunately, in investing, when you have investors to report to, a lot of times, the outcome is just as important as the process too, So it's just a hard way to make money, I feel like.
Yeah. Here I see some. They apparently they agreed to restructure the business, and they dodged a pyramid scheme label, and instead they had to pay $200 million.
What's that for them? Nothing.
Yeah, exactly.
Cost of doing business, man. Yeah. So it's just, I don't know. I mean, like, again, so he was right on the fact that there's some shenanigans going on with the business, but wrong on the outcome. Imagine spending. Do you remember how much he said he was going to spend on that situation? It was a lot. I remember. Yeah, on the whole Herbalife battle. I know he spent like a significant amount of money on it. Probably. And just like the brain power and, constantly just like probably banging your head on the wall and the fights back and forth and this and that. Is it worth it? I don't know.
No. Yeah,
not to me. I don't, that's not my personality. And I don't think it's a good way to make money. I mean, some people do it. Like Chanos is a legend. Bronte Capital guy is phenomenal. But me personally, so I would never discredit somebody else there, but me personally, I just would never do it,
Right. You're too positive.
Number 6, owner-operators preferred. I think that goes with saying, what does their salary look like in relation to the amount of equity they own in the company? I think that's great. He lists some examples: Sam Walton, Steve Jobs, Jeff Bezos, Warren Buffett, all owner-operators, fanatics about their business. Thoughts?
I agree
too. Number 7, you need time. It says use the coffee can approach as a crutch. So the coffee can approach is something we did a podcast on. Basically, when you buy a stock, you put the stock certificates in the coffee can, you put it under the bed, you never look at it. I asked Geoff recently on a video for our app that I don't think got uploaded yet, if he was running his own capital, how would he do that? And he said he wouldn't even think about it really as a portfolio. Just he would try to come up with a stock every single year. So one stock a year, he would never sell. Eventually the losers would just become such a small part of the portfolio, but the larger, winners would just make up the whole thing. It's an interesting way. I think it's really good for investors. He lists some examples in this book. I don't have it right in front of me, but basically where some guy had to pay for, of course, this is all hindsight bias, survivorship bias, blah, blah, blah. But let's try pull some some principles from it. Some guy had to pay I don't know, he had a really good trade or something, and he had to pay doctor's bills. So he liquidated the stock, and I think it was like $8,000. But that $8,000 today would be like $800,000 or just something crazy like that, So it's like, wow, that was an expensive doctor's bill. And it's true too, right? If you look at your portfolio every single day, I feel like it's easy for people to be like, well, I just want to trim this. I want to add to this. We don't really do any of that. Buffett doesn't do any of that. What's that book? Permanent Value. They were talking about Buffett in his early days when his broker would buy stocks for him. He would never ask, how much do you want me to buy? It's just buy as much as you possibly can. And a lot of times that's what happened for Buffett. He would just buy as much as he possibly can and then really just stop based on if the stock price moved up and he didn't want to buy any more from there. I don't think he ever went into it with I'm going to make this a 10% position in my portfolio. But yeah, the coffee can approach, I think it's a great approach for everybody to follow, especially if you're an individual investor. And it's one of those things that, is just a great mindset to have.
Mm-hmm. I guess that my main criticism of that coffee can portfolio is probably two-sided. First of all, as you mentioned, survivorship bias. Like, you have to buy companies that should exist, 20 years from now. And it's implicitly a bet against mean reversion, right? You're betting for that a company's dominance. I guess you're buying a high quality company. So you're betting that the current dominance will prevail or it will get stronger. Of course, this all varies from business to business. And then second of all, we discussed multiple expansions, and you're not going to get any gains from multiple expansions if you just buy one stock and you hold it for 50 years, because that's going to be diluted by the sales growth and the dividend yield and so on. So I guess it's kind of contradictory to the multiple expansion point, right?
Mm-hmm.
So you miss out on, you can't buy, but that's a whole different strategy. So when you buy the coffee can portfolio, you only have to buy these high quality companies that are very often very expensive, and then you just need to hold them over a long period of time for the earnings growth or the margin expansion or something like that to justify the current price. But I think that you may be, there are always opportunity costs, and you're kind of trading away your opportunity of flipping the cheaper stocks on the market, right? Do you agree?
Yeah, I mean, everyone has. When I answered that question, I said I would have, literally, my portfolio would be 3 to 4 stocks, or like 3 to 5 stocks. And Geoff said he wouldn't even think about it as a portfolio. He would just be like individual tickets and hold it forever. But yeah, I mean, everyone has their own approach to it. I think he owned Activision when he was a teenager. I feel like he said he'd put like $10,000 in, and today that would be worth like a couple million or something.
Wow.
Which
I think
maybe if he held it, none of this would be going on. So maybe there's some good situation.
He has this great blog post, right? He has this great blog post called "Has My Selling Decisions Ever Added to Anything?"
Yeah.
And I think he opens it with talking about his Activision purchase in like the year 2000 or something like that, and he said that the added CAGR, this was in like 2015, the CAGR would be like 20%. So, and this was one of the first stocks that he bought. So if he just bought Activision and he held it and added to it over this 15-year period, he would do pretty well.
Yeah,
that's pretty well. Yeah,
funny. All right, let's see. So number 8, we got 2 more. It says you need a really good filter. So I think this kind of goes hand in hand with the coffee can portfolio in a way. He said to you, let's see. My own study of 100 baggers shows what a pathetic waste of time it all is to, watch financial media and everything every single day. I'm kind of summarizing. just so you know.
Mhm.
He said to get over this, you have to first understand the stock prices move for all kinds of reasons. Sometimes stocks make huge moves in a month, up or down, and yet the business itself changes more slowly over time. I always say stock prices move faster than real businesses do. And he's basically saying if you're going to hold a company for, 100x, you got to be able to, I guess, withstand the volatility and focus on what really matters. There's that famous quote or whatever about Jeff Bezos and Amazon. How many times did Amazon lose like more than half its value along the way? So really just holding on for the long term, focusing on the business, make sure that management's still executing and the business is still growing, and try to really separate, the business from the stock price.
Right. Great point.
Number 9, luck helps. We don't really need to go into that because I think we all understand it. Luck helps.
Oh,
Luck,
okay.
true, I guess. 10, last one, you should be a reluctant seller. And he was talking about, and he quoted Philip Fisher. And he says, in his book, Common Stocks and Uncommon Profits, Phil Fisher had a chapter called When to Sell. He summed it up this way. Perhaps the thoughts behind this chapter might be put in a single sentence. If the job has been correctly done when a common stock is purchased, the time to sell is almost never. So that's that, which I guess goes against your flipping thesis that you just talked about. But, everyone has their own style. But I just think, I thought these were interesting principles from Hunter Baggers. Do you have any thoughts on that? When to sell, almost never?
What was that?
When to sell, almost never. Philip Fisher.
Yeah, exactly. I was just looking at the book as I got it on the shelf here, and it's all aligned. It's a classic Phil Fisher, I guess. And I mean, if you find a great company and it's high quality and you like the market position, you like the moat, maybe it's owner operated, there probably shouldn't be a reason to sell like over time if you do your work. So I guess I agree with that point, but I just wanted to add that there's this opportunity cost of the inability of flipping stocks if you're into that. And I'd like to add 6 points that I just got in front of me right here. That is basically, these are very similar points, but they're more like focused towards the medium cap and the small cap space. So have you read the book Hidden Champions of the 21st Century?
Yeah, I have. That's Jeff's favorite book.
Oh, really? Is it?
Yeah,
that's cool.
That's one of his favorite books.
These are like 6 points from that, not from the book, but like that are summarized. It's basically a summary of the entire book. So how do you find a hidden champion in the 21st century? And these are usually like 10 back. What was that? Maybe.
Is this the summary I tweeted out? All right, let's hear it.
I don't know. Number 1, they're usually family-controlled smaller companies. 2, they tend to focus on engineering and manufacturing of capital goods. And 3, they are technical leaders within their fields. They tend to be market leaders in some business-to-business capital goods manufacturing niche. Usually they're like top 3 to top 1 in the world. The initial niche is usually in just one country. In the book, it was usually in Germany. So eventually, as they grow larger, they have to, they end up with a lot of export sales to get like really big, to become like global champions of their niche. And 5th, they have okay margins, but not great asset turns or return on assets, which means that they usually don't show up on screens as amazing companies for investors. But over time, their returns for the investor are terrific. Then number 6, the actual business is not very well known to the general public. And I thought was this what you tweeted out?
No, I don't know, but those are all really great principles. Yeah. I mean, I agree with that. Looking for companies that may not screen well today, but they're going to look, different and potentially screen well 2, 3, 4, 5 years into the future. Sometimes I think if you screen for, typical screens, low PE, high free cash flow yield, blah, 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 how much other value investors are, searching in that pond. And to my point earlier, I feel like a lot of value investors, if they look at a company today and it's not generating free cash flow or net income, a lot of times they disqualify it, right? They may disqualify that story. and maybe the management is purposely not generating free cash flow or, net income. Well, maybe they generate free cash flow, but not net income or something like that. So I just think the more, experience I get, the more it's just important to study each company by a case-by-case basis and try not to disqualify right away until you really figure out the story, and the situation. So those are all great points, really great points.
Right.
Cool. You like that book?
I haven't read it.
Haven't read it. Well, there you go.
I've just read like a ton of summaries, but I actually haven't read it.
Good stuff.
Bad way to end the podcast.
This is a great way. That's great. Well, cool. I want to thank everybody so much for tuning in with Vetla and I. Vetla, this is fun. We should start doing stuff like this. Whatever you're reading, a book or something like that, just bring it. Let's talk about it on the podcast or on the rundown and, see where we end up. I want to thank everybody so much for joining the both of us today. Make sure you follow Vetla on Twitter. His handle is in the About section. He is great on Twitter, always puts out tons of information. Where's the label on that water bottle?
Where's the label? This is
That's good. We don't want to get sued. Good job.
Yeah, I know. Exactly. Well, it's not a Coke.
It's just water.
Random. Yeah, it's just water.
That's water. Cool. I want to thank everybody so much for joining in. Be sure to hit that subscribe button, and we will see you in the next video.